Hello, this is Russ Allegrette from Ocean West, and I've got Dennis Kiely with me
Hello.
from DLA Piper. We're actually together today, which is a good thing. And we want to welcome you to our podcast, Leading Indicators. Today, we're very fortunate. We have Andrew Mullin. Andrew is the head of portfolio and asset management for Deutsche Bank, basically heads up the balance sheet for Deutsche Bank. Working with a variety of lenders over the course of my career, I would say Andrew is probably one of the more forward-thinking, one of the very smart lenders that are out there. We're fortunate to have you. Welcome, Andrew.
Thank you, Russ. Great to be here. Look forward to
Yeah.
participating.
Give us just a little bit of a brief background on you and then what you're responsible for at DB right now.
Absolutely. So I have been here at Deutsche Bank for going on 18 years now. Always in the commercial real estate part of the business in the investment bank. I have had a number of roles over the years in the capital markets business, our CMBS business, as well as the balance sheet, as well as our special situations group buying distressed NPLs coming out of the GFC. Today, I oversee our balance sheet globally, which is around 26 billion euros. 20 billion of that is here in the US, in North America. The rest is in Europe. And I am very involved in the asset management workout of any problem loans on our balance sheet, which we have had our share. And so that's been a big focus of mine over the last few years with the cycle we're in.
So, with your responsibility with the balance sheet, which obviously is big and it has been changing, I know you are responsible for modifications and workouts. Can you tell us a little bit about, as a balance sheet lender, how do your motivations and your process differ from what a CMBS lender would have with respect to any types of loan workouts?
Unlike a special servicer CMBS trust, we have a direct relationship with our borrowers. These are typically repeat borrowers. We spend a lot of time on who we actually lend to. So these are typically very institutional borrowers who are well capitalized. When loans get into a bit of distress, we try to work with our borrowers. We have deep standing relationships with them. They are very good most of the time about defending the assets, supporting the assets. So we will try to restructure loans where we can. We've had a very strong track record of restructuring loans with our existing borrowers. We've done over 9 billion of loan restructuring since the second half of 22. We've had over 700 million of equity injected into these deals, which is key because we don't want to just do extensions, restructurings where the bank is really getting nothing in return. So we do look for a balanced deal where we're getting the sponsor to commit additional dollars equity into the transaction. And that could be to pay the loan down, but also to provide additional interest reserves, interest and carry reserves. We will also look for TILC money to go into the deal. So just we need to see a measurable sort of injection of equity to continue to demonstrate they're committed to the asset, and then we will work with them. And there's a myriad of ways we've been working with our borrowers. We have been, in some instances, reducing the coupon to help, given the debt service has gone up significantly. A lot of these are floating rate IO loans, very sensitive to short-term interest rates. So with the increase in LIBOR, SOFR, their debt service has increased. And so we've been trying to give them relief there by reducing the coupons, fixing the coupons, but only if we see them, again, injecting equity as well. We've also been, in some instances, open to partial DPOs where we'll write down some of the debt where we know the capital stack is clearly over levered. And as long as they're willing to recommit to the asset and inject more equity, we can potentially write down some of the debt to just get to a more sustainable place and resize the debt so that there's a path to ultimately executing on the business plan and refinancing the loan down the road. We have been looking at A-B structures. This is where basically the lender agrees to cut the senior loan into an A note and a B note. And that allows the borrower to inject new equity, typically senior to the B note, but junior to the A note. That's not something we do much of here at DB. I think that's primarily due to our accounting treatment and reg treatment, where when we do that, it flips the accounting treatment to market for the A note. And we have to hold very significant capital, not just against that B note, but also the A note. So it's a structure that doesn't get us much but I know it's a structure that others have been participating in. So a lot of other lenders have been doing. And then, look, I think we have also been open to deferred interest in some instances where it picks over time, and we put them on a schedule, amortizing over certain milestones that they're able to achieve. Like everybody else in the market, we've also been extending loans out, significantly. So giving them multiple years of additional term, just because a lot of these assets just need more time to ultimately stabilize. Where the borrower is not willing to commit additional dollars and not really willing to support the asset, we're typically either looking to work with them consensually to do a deed in lieu of foreclosure and take back the asset and bring in an operator who's capable of operating it for us, or looking to have them actually do a short sale where we have them go to the market and sell based on, it's basically a lender directed sale, and we'll often need to provide seller financing to the buyer in those instances. And we've also been doing note sales where if we can't really get the cooperation of the underlying borrower, we'll just go to the market and look to sell our note. We can provide note on note financing to buyers as a way to help improve the returns and the liquidity. We actually were just in the market with $1 billion portfolio of sub-performing, non-performing, and performing loans, which we've signed up to counterparties to purchase, all cash. And I think that was a really good data point in just terms of liquidity returning to the market. The buyers for this pool were all institutional. It was very, very well bid. We had 52 initial bids. We took 18 investors to a best and final. We're ultimately going to trade to 2 investors, but they were all institutional, which I think that's a big change I've seen in the market, because a lot of these other previous sales we've done, particularly in office, there was no real institutional participation. It was primarily high net worth, family office, local developers, very little institutional participation. So I think that's a very good sign overall for just the ability to exit some of these situations where you can't work them out with a borrower and there is a bid out there.
Question about in terms of subordinate lenders or mezzanine lenders, how have you seen them being involved in the process of doing these workouts, and any observations on that?
So I would say it often comes down to value. And if they determine they're significantly out of the money, they typically let us know that they don't plan on supporting the asset. They're not interested in stepping up and taking ownership. They're not looking for us to try to restructure the existing debt with them. They're really just kind of deferring to the senior lender, whatever they want to do in terms of the ultimate workout strategy is. In most of those instances, they've already written off their investment. They're mostly interested in just, quite frankly, trying to get out of their obligations as soon as possible. And I've seen a lot of other instances, though, where their equity is impaired or their debt is impaired, but not wholly impaired. So there is some value left in their instrument, and it depends on their expertise and capabilities, but we've seen a decent amount of mezzanine lenders actually step up and take over the real estate. And then we've restructured the debt with them, where we've given them additional term and in some instances changed the coupon. But we've looked for them to ultimately pay that loan down to get us to a better basis. But we have been willing to restructure loans with a number of mezzanine counterparties and give them significant term, 5 years of term. We've also been willing to restructure the coupons to make it a little less burdensome from a debt service perspective. And I've seen that particularly in multifamily, where you have negative leverage today, but I think it's not a structural issue. And if you saw a little bit of cap rate compression, they could very quickly recoup their entire investment. In those instances, I've seen mezzanine much more willing to protect, and they're just looking for more time from the senior lender.
But what about pari passu debt and working with other lenders? What are some of the issues and what are some of the strategies you use to get consensus?
Unfortunately, earlier on, we weren't on sides with some of our participants as agent, where we had proposed a modification where, again, we were going to get a significant equity infusion, a pay down, and in return, we were going to lower the coupon, give them additional term, significant term, 3 to 5 years. And then they were going to recommit to the asset and inject a lot of equity. We had certain participants who I just don't think were comfortable with that. And at the time, they didn't appreciate what had happened in the market and how much values had fallen. And so they really thought that they had liquid paper and they could get out at par. So either they wanted us to buy them out at par, or they thought they could sell and get close to par. And what they found out when they went to the market was there was very little liquidity at the time and there was no ability to get close to par. So then they kind of came back to us and said, all right, we're willing to now come aboard with this modification you proposed, but unfortunately that window had closed. The loan was now in default and we were in a non-performing loan, very different situation. We have proposed in some of these instances a partial DPO, or we have also proposed doing a deed in lieu or foreclosure. It has proven to be very complicated to get everybody sort of drive consensus around what that business plan looks like, what the control rights should be in terms of that ultimately that operating agreement with all the different participants. So trying to negotiate that joint venture ownership agreement when you take control of the real estate has proven very difficult. I think everyone at a sort of high level understands that's probably the right way to go. That's the right plan in terms of maximizing recoveries. It just gets bogged down oftentimes in how much control people want around decision making, who the operator is, approval over the budget, the business plan. So it's proven to be pretty difficult to execute. It's taking much longer than we would have envisioned or liked. And I think what's happening is some of our syndicate members are getting frustrated with the timing, frustrated with the process, and they're actually looking to trade out. So the other thing that's, I think, interesting that's occurring in the market is there is more activity. There's more capital looking to be deployed into these situations. So there actually are buyers who will buy these illiquid participants out in stacks. And I think their strategy is to try to buy enough of them out where they can get to a controlling position where they can sort of inform the strategy with the agent on how you recover. Or look, they're buying it at such a low basis that they just look at it as, I have uncertainty around the timing, but whenever that exit occurs on a blended basis, I'm going to have a really good resolution. So more and more of this paper is starting to trade out there. And I think it's also, I need to be aware of that because it potentially changes the strategy for us if we have other people coming into these capital structures who may have a different view on how we should be ultimately trying to maximize recoveries. It may be they actually want to go to the market and sell instead of taking back the asset, or they may want to try to go back to the borrower and see if we can induce them to do a partial DPO and then provide financing at a written down debt basis. We're seeing a lot more activity around these stacks. And it's creating more optionality, but at the same time, I think it's making it more complicated in terms of trying to figure out what the strategy should be and sort of driving that consensus.
Interesting on the note purchases. So who are you seeing in that market? Are you seeing funds? Are you seeing banks? Who's playing
It's
in that
definitely
market?
not banks. It's a lot of opportunistic debt funds who raised a lot of money around this distressed opportunity and had a very difficult time deploying into it. It's hedge funds, surprisingly, who I think just smell cheap. They think, they don't understand exactly what the trade is, and they don't really understand their underlying real estate that well, but they just look at it on a per foot basis. That seems extremely cheap to them. And so they're looking to deploy into that with their sort of distressed special opportunity money. Quite frankly, there's also, I think, operators out there who I think are starting to see a way to get into these capital structures and then be the solution in terms of they will come with their capabilities and their expertise to be able to actually to manage the asset, and then they will have a very high degree of influence ultimately on the outcome. And in return, they're buying into these stacks as well. So they're bringing money, capital to purchase some of these participating positions in the stack, but they're also offering to manage the asset and operate the asset and come up with a business plan. And they have the capabilities to do that, which makes them very compelling.
Obviously, there's been a lot of problems with office. Are you seeing any problems with other asset types? And have you seen more people willing to invest in office and try to provide some solutions there?
I would say in terms of just general stress out there, it's really two asset classes. It's multifamily and it's office. Away from that, we see some, stress, but it's very idiosyncratic situations in hospitality, retail. Really, it's legacy issues coming out of COVID that never got resolved. But primarily, since interest rates started going up in 22, the impact's really been felt on multifamily and office. With multifamily, I think it's more people bought in at very tight cap rates, 4% cap rates. Interest rates went up, cap rates moved out, and they've also seen a meaningful uptick in their debt service because the floating rate reset. So caps are getting much more expensive. There are shortfalls, so they're coming out of pocket every month to feed debt service, and they're looking at a wider cap rate, so the values have come down. And so the question has been for a lot of these folks, do I still have any equity left? And should I be continuing to put money in for these shortfalls every month when my equity may be wiped out? Because I don't know when interest rates come back down and whether cap rates will come back down. So that's really just a negative leverage issue. And people have been very willing to buy into those situations. So there's a ton of liquidity out there looking for those opportunities to buy in at a better basis. And so the guy buying into that can immediately reset the basis, and they can be at a debt yield of 6.5%. So there's no longer negative leverage. The cap rate's 5, they're at 6.5, and it's sustainable. And ultimately, there is plenty of financing out there that could refinance those opportunities. You just need to reset the basis. Office is different. So office has structural issues, as we all know. It has been, unfortunately, that all office was painted with the same brush of, it's going to be very, very difficult to lease up. A lot of it is obsolete. Even the good office may not have a lot of demand from users. That is starting to change. And there's I look at a lot of different indicators out there, and they're all starting to show some stabilization in parts of the office market. I look at Green Street. That's an index that basically it's a time series of unleveraged U.S. property values. And it basically captures the prices at which commercial real estate transactions are being negotiated and contracted. That index is actually shown for the last couple quarters, basically flatlining for office. And in fact, in a few of the property types, we've seen a small increase in value. So there's definitely a stabilization happening or a bottoming happening. Unfortunately, though, the damage is done in office. On average, I think office is, it depends on whether it's Class A or Class B or everywhere in between. Office is down anywhere from 30 to 70% on average. So there's a major issue with a lot of these capital stacks are underwater, and a lot of the borrowers are no longer in the money, and so they're no longer willing to support these assets. For the Class A, there's definitely capital that wants to invest in those situations. They just need to reset the basis. And, in certain markets, we're actually seeing a very strong sort of return to office, a very strong uptick in leasing. I'm here in New York City. That's where we're based. And we've seen a significant uptick in leasing in Manhattan. In fact, the demand for office in Manhattan is at levels now we haven't seen for 10 years. We had the highest net absorption in a decade last quarter. There's definitely significant momentum now in New York City with a lot of tenants were on the sidelines there was a lot of uncertainty as to what the use case was going to be and how much square footage they needed. I think there's a lot more certainty now. And so there's a scramble now to actually try to find quality space. And I would just caveat, though, that where we're seeing a lot of this activity is in the best buildings, the highly amenitized sort of Class A buildings in certain corridors in Manhattan. But you're actually finding a scarcity now in some certain areas in Manhattan. And it's really creating a lot of ability to actually increase rent, which is helping the market. And I also think you're starting to see that trickle down to what I'll call the Class B plus, but the sort of second tier below the Class A buildings are starting to catch a bid because people just can't find space in some of the best buildings, so they're having to look elsewhere. That said, there's still an issue with those Class B minus buildings in tertiary locations that there's just not a strong use case anymore as office. And some of those will be converted, but the conversion trade, that's very particular because it's very, very expensive. You have to buy at a very cheap basis to make that work. And some of these just don't have the footprints that allow it to be converted. So I do think, though, that conversion trade is taking a decent amount of space off the market. That's helping with absorption overall. And I think that will continue. And I think this is another data point I would just say is there's no new construction. So no one is developing new office buildings today. And so that's eventually going to become a tailwind as well, I think, from an absorption perspective. But we need to see more of that in other markets. So I'm not seeing a lot of that on the West Coast. I'm not seeing that in DC. So we need to start seeing other CBDs show similar activity. I think it's just a matter of time. And a lot of these markets are trailing New York, but eventually you'll see I think you'll see more activity in a similar trend.
Do you see any other sectors where there might be trouble on the horizon other than multifamily and office?
Industrial, there was a lot of supply that came online. Some of these markets you're seeing negative absorption. There's a lot more cushion in industrial, though, in terms of you could see a decent amount of decline in value, but they've been able to increase rents significantly over the last few years. That really provides a buffer for any cap rate driven valuation declines. The question is, will that, will the rent increases we've been seeing in industrial continue? And it's the rate at which we're seeing rents increase has slowed down. Still able to actually increase rents. We're certainly steering clear of some markets in terms of doing new spec construction. But where you have tenants in place, I still feel pretty good about industrial. Data centers are another big area of growth right now. And there's some questions around, is that sustainable? Will those become ultimately obsolete? Is there oversupply? But most of the metrics I look at tells me it's still very underrepresented and they need to build a lot more data centers to meet the demand out there. But you want to be careful on, you want to typically be doing hyperscalers. You don't want to be doing the tertiary data centers. There's, obviously the big question around what's the source of both water and power. And people are starting to move further and further out from, the preferred locations where there are some questions about, whether some of these projects are going to be feasible long run.
Hey, Andrew, so we talked a lot about distress. You're being in charge of the balance sheet and being one of the top people at DB on the real estate side. You're also working on new lending. How's that changed in the last year, 6 months, 3 months? What are you seeing?
Yeah.
What are you doing and what are you seeing?
So the biggest change I would say is in CMBS. So there's been a significant uptick in CMBS lending this year from 2023. 2023 was a very, very anemic year from a CMBS perspective. 2022, I think there was 70 billion of CMBS in the US issued. There was only 40 billion done in 2023. In 2024, we think we're going to close around 90 to 100 billion. And that'll be close to 2021, which was sort of a record year from an issuance perspective since the GFC. So that's a really good sign. The capital markets are back. CMBS lending is very active. And one of the even better sort of signs I'm seeing out there that gives me a lot of encouragement about office is there's actually a decent amount of CMBS lending on office today. We've been leading the way with that. We did 277 Park Avenue this summer. That closed on August 8th. That was a 750 million mortgage. We securitized 650 million of that. That was the largest CMBS deal on an office, single asset, single borrower deal since 2021. And it was oversubscribed. The market, it was a little opaque whether that was going to be well received by investors. Are they willing to buy large office like that, which is very concentrated in one asset? but investors couldn't get enough of it. And we were able to tighten pricing in, and it was, again, multiple times oversubscribed. So that was a very strong signal that investors are back. They're willing to buy office. Now that was Class A office, but I will tell you, it had significant issues around roll, where JP Morgan has around 47% of the NRA. They're building a new headquarters across the street where they're going to be consolidating, I think, a lot of their space. And so that rolls in 27, and there's a lot of question marks on, whether they're going to stay or go, and how difficult would it be to lease up, that amount of space. However, we had some structural features that I think were well received to mitigate that, where we actually had the sponsor put in a $180 million re-tenanting reserve to basically cover over that roll. And so you were really protected up from the downside in terms of that roll risk, because you had this reserve in there. We also had 53 million of interest reserves, 13.5 of capex reserves. So it was a well-reserved, well-structured deal. Now, only certain sponsors can do that, because obviously that's a lot of capital going in up front. That, I think, was what ultimately got investors comfortable with leaning in on that deal. And since then, we've just seen a whole slew of follow-ons. We just did 731 Lexington Avenue, which is the Bloomberg headquarters. We're bidding on 3 Bryant Park. You probably saw in the news that Tishman was able to refinance Rockefeller Center, $3.5 billion CMBS deal, the largest I can remember. So there's definitely a lot more liquidity now in office, Class A office. CMBS is there. Smaller deals are getting done as well, and those are going into conduit transactions. And one of the biggest constraints has been, investors had been telling us that they would only allow a certain concentration of office in these conduit pools, no more than 15%. That has now moved to 20%. I think, there's probably an opportunity to push that even more, maybe to 25%. And what's good about that is, yes, it's going to be some of these larger SASB deals that get cut up, and some of it is put into these conduit pools as a way to just sort of move the risk. And also there's difference in pricing. But I also think, this is allowing smaller office deals to get done in CMBS. And that's going to be super helpful. A lot of the sort of mid-tier sponsors who have a loan coming due, and there's not a lot of regional bank money to refinance that today. The CMBS market, that's offering liquidity where there's a lack of liquidity right now. And that probably leads me to the last point I'll bring up here is, there has been a tremendous amount of extending loans, not just office, in general. And so a lot of the institutions out there, a lot of the lenders out there, particularly the regional banks, have just been extending loans as they come due. And this has been going on now for several years. And so you're seeing a maturity wall that continues to get bigger and bigger. They're just pushing out the problem, and the problem's getting bigger and bigger every year. At some point, I think that becomes really difficult to continue, because you're not getting anything in return on a lot of these extensions at this point. The borrower is, for the most part, on a lot of these, checked out. So they're no longer supporting the operations. They're no longer spending money to lease it. And the regulators, I think, are taking a closer look at a lot of these situations and saying, hey, you're basically covering up what is a non-performing loan, and you haven't rated it properly, you haven't classified it properly, and you need to impair that loan now, and you need to change the rating. It's a defaulted loan. And that's going to put more pressure on them to actually deal with a lot of these problem loans on their balance sheets that they've sort of been masking as performing. And so I think what that ultimately means is you're going to have to see a lot more selling, because a lot of these lenders are also not set up to own real estate. And so there's just going to be a lot more pressure, I think, going into 25, 26 for a lot of these lenders to clean up their balance sheets and start to de-risk, which will be an opportunity, I think, for the market, because I think there's just been a lack of these opportunities out there and scale for the capital that's been raised for these opportunities to deploy into. But that, I believe, will start changing, and we're already starting to see it on my end. every day you're seeing more come to market.
Yeah, I think we need that. I mean, when you look at the amount of sales that have happened over the last 2 years, it's been about half of what the normal volume is. I think that that's a good thing. Hey, Andrew, this has been fantastic. We really appreciate it. I know we could go on with you for another 2 hours. I think this has been one of the more informative sessions we've done. So
I agree.
thank you so much. We really appreciate it. Is there anything else you want to add before we leave?
No, I just appreciate the opportunity. I enjoyed this very much. And I'm willing to come back if you'll have me.
Okay.
We might have an encore presentation.
Yeah, exactly.
All right.
Thank you so much.
Great.
We really
Thanks so much.
appreciate it.